Welcome to this enlightening journey where we explore The Intelligent Investor by Benjamin Graham, a masterpiece that has stood the test of time in the world of finance. Whether you're just starting out or are an experienced investor, this book offers insights that will change how you think about investing forever. Here at Asset Investor, we believe in empowering you with the tools to build and protect your wealth. As we go through this audiobook summary, we'll break down complex financial concepts into easy-to-understand principles that you can immediately apply. So get ready to dive into one of the most influential investment books ever written, hailed by experts and novices alike. Today, we'll guide you through the 20 chapters of The Intelligent Investor, revealing the wisdom that has shaped countless successful investors, including the legendary Warren Buffett. Benjamin Graham's philosophy of value investing is timeless, teaching us how to approach the market with logic and patience rather than emotion and speculation. Grab your notebook, settle in, and let's embark on this transformative experience. By the end of this journey, you'll have a clearer understanding of what it means to be an intelligent investor, and you'll be ready to take charge of your financial future. Chapter 1. Investment versus Speculation. Results to be expected by the intelligent investor. To begin, we must understand the fundamental difference between investment and speculation, a concept that Benjamin Graham takes great care to explain. The intelligent investor, as Graham outlines, seeks not to predict the future, but to invest based on the intrinsic value of a company. In contrast, speculators make decisions based on market trends, often hoping for quick, short-term gains. Graham begins by stressing that the stock market is a voting machine in the short term, but a weighing machine in the long term. What does this mean? In the short run, stocks are subject to the whims of the market, driven by public opinion and emotion. However, over the long haul, the true value of a company emerges, and that's what intelligent investors focus on. Their goal is to identify companies with solid fundamentals, regardless of current market conditions. He introduces 3 key principles that all investors should follow. 1. Conduct a thorough analysis of any company before buying its stock. This is not just about looking at stock prices, but understanding the company's balance sheets, income statements, and its long-term prospects. 2. Seek a margin of safety. This concept is central to Graham's philosophy. It means investing in companies that are undervalued, where their current stock price is lower than their intrinsic value, providing a buffer against potential loss. 3. Expect reasonable returns, not extraordinary ones. Intelligent investors are not out to beat the market by a wide margin. Instead, they aim for consistent, moderate growth that compounds over time. This cautious approach, as Graham explains, is far more reliable than chasing after high-risk, high-reward investments. This chapter also highlights the psychological challenges that investors face. One of the greatest enemies to an intelligent investor is not market volatility, but rather their own emotions. Greed and fear can lead even the most well-intentioned investor astray. By sticking to a well-thought-out plan and avoiding the pitfalls of emotional decision-making, you can achieve long-term success. The key takeaway here is that being an intelligent investor means embracing discipline, patience, and most importantly, the ability to think independently of the crowd. Chapter 2. The Investor and Inflation. As we move forward, Chapter 2 tackles a critical issue: inflation and how it impacts your investments. Inflation, the gradual rise in prices over time, can erode your purchasing power if not properly accounted for in your investment strategy. Graham begins by reminding us that inflation is a constant threat to all investors. It may not always be noticeable, but it is always present, slowly chipping away at the value of cash holdings. If you're holding cash, you may feel secure, but over time its real value decreases. So how can investors protect themselves? Graham suggests two key strategies. 1. Investing in stocks as a hedge against inflation. Stocks represent ownership in businesses that have the potential to raise their prices to keep pace with inflation. While stocks can be volatile in the short term, over the long term, they tend to provide a higher return than fixed income securities, making them a more reliable safeguard against inflation. 2. Consider bonds carefully. Bonds are traditionally seen as safer than stocks, but Graham warns that they may not always be the best defense against inflation. Fixed income securities like bonds pay a set interest rate, which can lose purchasing power over time as inflation rises. However, he introduces the concept of inflation-linked bonds, which adjust their payments based on inflation levels, providing a more secure income stream in an inflationary environment. Finally, Graham touches on the importance of diversifying your portfolio to protect against inflation. By holding a mix of asset classes, stocks, bonds, and even real estate, you can reduce your exposure to inflation risks and create a balanced investment approach. Chapter 3. A Century of Stock Market History. The Level of Stock Prices in early 1972. In Chapter 3, Benjamin Graham takes us on a historical journey through the stock market's ups and downs, focusing on the long-term trends rather than the daily fluctuations that dominate news headlines. This chapter provides a historical perspective, allowing us to see that while stock prices may fluctuate in the short term, they have generally trended upwards over time. Graham begins by discussing the historical performance of the US stock market from the early 20th century through to the early 1970s. He reminds us that stock prices can be highly unpredictable in the short term, but tend to follow more predictable patterns over the long term. The chapter emphasizes that investors should not be overly optimistic during periods of market booms, nor should they become too pessimistic during periods of decline. This historical context helps us understand that markets have always gone through cycles, and those who remain patient and disciplined will ultimately fare better than those who panic during downturns. He also introduces the concept of market levels, describing how stocks have historically been either undervalued or overvalued at various times. In 1972, for example, stock prices were at historically high levels, which Graham warns could lead to inflated expectations among investors. This is where the principle of value investing comes into play, buying stocks when they are undervalued, rather than simply following the crowd during periods of market exuberance. Graham explains that successful investors should use history as a guide, but not a crystal ball. We can look at the patterns of the past to help inform our decisions, but we must remain realistic about what the future may hold. The intelligent investor is always aware of the market's tendency to fluctuate and is prepared for both highs and lows. Ultimately, Graham advocates for a conservative and balanced approach, focusing on a strategy that withstands market volatility over the long term. Chapter 4. General Portfolio Policy. The Defensive Investor. Chapter 4 marks the beginning of Benjamin Graham's detailed advice for two types of investors, the defensive investor and the enterprising investor. This chapter focuses on the defensive investor, someone who is more cautious and seeks to minimize risk while still achieving reasonable returns. Graham's advice for this type of investor is to maintain a balanced and conservative portfolio. The defensive investor's goal is not to beat the market, but to avoid making mistakes that lead to significant losses. As Graham notes, the defensive investor is one interested chiefly in safety plus freedom from bother. To achieve this, Graham suggests dividing a defensive portfolio into two main asset classes, stocks, and bonds. His recommended split is between 25% and 75% in each, depending on the investor's confidence in the market. For example, if you believe that stocks are overvalued, you might lean towards 75% in bonds and 25% in stocks, and vice versa when stocks seem undervalued. The most important aspect of the defensive portfolio is diversification. Graham stresses that spreading your investments across different industries and asset classes helps to mitigate risk. Even if one part of your portfolio underperforms, other parts may do well, thus providing a cushion against potential losses. He also touches on the types of stocks defensive investors should consider. These are large, well-established companies with a history of stable earnings and dividends. The idea here is to avoid smaller, riskier companies that may offer higher returns but come with far greater risks. In short, the defensive investor focuses on steady, long-term growth by maintaining a balanced and diversified portfolio. The goal is to achieve reasonable returns while minimizing exposure to unnecessary risks. Chapter 5: The Defensive Investor and Common Stocks. In Chapter 5, Graham delves deeper into the topic of common stocks for the defensive investor. While the previous chapter introduced the concept of a balanced portfolio, this chapter focuses on selecting the right types of common stocks for a defensive strategy. Graham advises the defensive investor to look for stocks that meet the following criteria. 1. Large, prominent, and conservatively financed companies. These companies are more likely to withstand economic downturns and maintain consistent earnings and dividends. 2. Companies with a long history of paying dividends. Dividend-paying stocks provide a level of income even when the stock price fluctuates, offering a cushion during market downturns. 3. Avoiding high-growth stocks. While high-growth stocks can offer substantial returns, they also come with much higher risks. The defensive investor should stick to stable, mature companies with a history of reliable performance. 4. A price-to-earnings ratio, PE ratio, below 25. This ensures that the investor is not overpaying for a stock relative to its earnings. Graham underscores the importance of sticking to these conservative guidelines. The defensive investor should not chase after the latest trends or hot stocks. Instead, they should focus on building a portfolio of reliable, established companies that offer a reasonable return without exposing the investor to undue risk. This chapter reinforces Graham's belief that the defensive investor must prioritize safety and long-term stability over short-term gains. By investing in stable companies with a strong track record, the defensive investor can achieve consistent returns without having to worry about the volatility of the market. Chapter 6: Portfolio Policy for the Enterprising Investor. Negative Approach. Chapter 6 shifts focus to the enterprising investor who is willing to take on more risk in exchange for the potential of higher returns. This chapter, however, starts by outlining what enterprising investors should not do. Graham warns that while the enterprising investor may be more active and aggressive in their investment strategy, they must avoid certain common pitfalls. Graham starts by cautioning against chasing after high-yield bonds, also known as junk bonds. While these bonds offer higher interest rates, they also come with significantly higher risks. The enterprising investor must resist the temptation to reach for yield without fully understanding the risks involved. Next, he advises against day trading and attempting to time the market. Many enterprising investors fall into the trap of trying to predict short-term market movements, which often leads to poor decisions based on emotion rather than logic. Graham warns that this approach is more akin to gambling than intelligent investing. He also cautions against investing in hot industries or companies that seem poised for explosive growth. These companies often attract speculative investors, and their stock prices can become overinflated. When the hype fades, the stock price often crashes, leaving investors with significant losses. Lastly, Graham advises against putting too much trust in market forecasts or economic predictions. No one can accurately predict the future of the stock market, and trying to do so is a fool's errand. The enterprising investor should focus on the underlying value of companies rather than trying to guess where the market is headed. This chapter serves as a reminder that while enterprising investors may take on more risk, they must do so intelligently and avoid speculative behavior. The key to success lies in disciplined analysis and avoiding common mistakes that can lead to large losses. Chapter 7. Portfolio Policy for the Enterprising Investor, the Positive Side. In Chapter 7, Benjamin Graham continues his discussion of the enterprising investor, now shifting focus to what such an investor should do. The enterprising investor, unlike the defensive one, is more hands-on and willing to actively seek out undervalued investment opportunities. However, as Graham emphasizes, this must be done with careful analysis and strategy, not speculative risk-taking. Here, Graham provides a framework for how enterprising investors can approach building a profitable portfolio. 1. Purchase bargain issues. A bargain issue is a stock that is priced far below its intrinsic value. The enterprising investor looks for these undervalued stocks, often in companies that are temporarily out of favor, but still possess sound fundamentals. This strategy relies heavily on Graham's concept of the margin of safety, where the investor buys a stock at a significant discount to its true worth, reducing the risk of loss. 2. Focus on secondary companies. Graham suggests that enterprising investors should look beyond the large, well-known companies and instead focus on smaller, secondary companies. These companies may not be on the radar of most institutional investors, but they can offer excellent value opportunities if they are fundamentally strong and undervalued by the market. 3. Special situations and arbitrage. The enterprising investor can also seek out special situations such as mergers, reorganizations, or other corporate events that create temporary inefficiencies in stock prices. In these cases, investors can exploit price discrepancies to earn a profit, a strategy known as arbitrage. However, Graham warns that these opportunities require in-depth knowledge and should only be pursued by those with the expertise to properly analyze the situation. 4. Focus on stocks with a low price-to-earnings (PE) ratio. Graham reiterates the importance of buying stocks that are undervalued based on their earnings. A low PE ratio suggests that the stock may be undervalued relative to its earnings potential, making it a good candidate for an enterprising investor's portfolio. 5. Look for companies with strong financial positions. While bargain hunting is central to the enterprising investor's strategy, it's essential to ensure that these companies have strong balance sheets and are not burdened with excessive debt. Enterprising investors should prioritize companies with low debt levels and strong working capital, as these businesses are more likely to weather economic downturns. In essence, the enterprising investor's success comes from diligent research, discipline, and the ability to identify mispriced assets. Graham highlights that this approach requires more effort and expertise than the defensive strategy, but for those willing to put in the work, it can lead to higher returns. However, caution is key, and the investor must always ensure that they are not falling into speculative behavior. Chapter 8. The Investor and Market Fluctuations. Chapter 8 is one of the most famous and essential chapters of The Intelligent Investor. In it, Graham discusses how the intelligent investor should react to market fluctuations. Rather than seeing volatility as something to fear, Graham argues that it presents opportunities for the patient and disciplined investor. Graham introduces the concept of Mr. Market, an allegorical figure who represents the stock market's mood swings. Sometimes Mr. Market is euphoric, offering to buy your stocks at inflated prices, and other times he is pessimistic, offering to sell shares at rock-bottom prices. The intelligent investor, Graham argues, should not be swayed by Mr. Market's emotional behavior. Instead, the investor should take advantage of the irrational prices that Mr. Market sometimes offers. Graham's main point is that the stock market is there to serve you, not to instruct you. The intelligent investor should take advantage of opportunities when the market undervalues companies, but avoid getting swept up in market hype when prices soar irrationally high. This is the core of value investing, buying when others are fearful and selling when others are greedy. He advises investors to adopt a long-term perspective and avoid reacting emotionally to short-term market movements. Market corrections and downturns are inevitable, but they should be seen as buying opportunities rather than reasons to panic. As Graham famously said, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." The intelligent investor focuses on the long-term value of their investments, not the short-term fluctuations in price. One of the key lessons of this chapter is to develop the emotional discipline to withstand the roller coaster ride of the stock market. By staying calm during market downturns and remaining rational during booms, the intelligent investor can avoid costly mistakes. This chapter also introduces the idea of dollar-cost averaging, a technique where an investor buys a fixed dollar amount of stocks at regular intervals, regardless of the market's current level. This method takes advantage of market fluctuations by automatically buying more shares when prices are low and fewer shares when prices are high, smoothing out the effects of volatility over time. Chapter 9. Investing in investment funds. In Chapter 9, Graham shifts his focus to investment funds, specifically mutual funds, and whether they are a good option for the intelligent investor. This chapter is highly relevant even today, as many investors prefer mutual funds or index funds to buying individual stocks. Graham discusses the advantages of mutual funds, such as diversification and professional management. For investors who lack the time or expertise to analyze individual stocks, mutual funds provide a way to gain exposure to a broad range of companies, reducing the risk of holding a concentrated portfolio. However, Graham also points out several potential drawbacks of mutual funds. One major issue is the fees associated with these funds, which can eat into an investor's returns over time. He warns that some mutual fund managers may not always act in the best interests of their clients and may engage in speculative behavior in an attempt to boost short-term performance. He advises investors to be cautious when selecting mutual funds, recommending those that follow a conservative long-term approach rather than chasing after short-term gains. He also suggests that investors look for funds with low fees and expenses, as these will have less of a drag on overall returns. In particular, Graham is critical of actively managed funds that try to beat the market through frequent buying and selling. He argues that many of these funds fail to outperform the market over the long term, and investors would be better off in low-cost, passively managed index funds that track the performance of the broader market. This chapter serves as a reminder that while mutual funds can be a useful tool for the defensive investor, it's essential to choose funds carefully and avoid paying too much in fees. For many investors, a passive index fund may be the most intelligent option, as it offers broad market exposure without the risks and costs associated with active management. Chapter 10. The Investor and His Advisors. Chapter 10 focuses on the relationship between investors and their financial advisors, a critical aspect for those who do not wish to manage their own portfolios. Graham emphasizes that while some investors are fully capable of making investment decisions on their own, others may seek the help of professionals. However, choosing the right advisor is crucial to ensure that your financial goals align with their advice. Graham begins by outlining the qualities of a competent and trustworthy advisor. First and foremost, the advisor must prioritize the client's best interests above their own. This means giving impartial advice that is not influenced by the desire to earn commissions or other fees. A good advisor should also have a deep understanding of value investing principles and should be able to guide clients through the ups and downs of the market with a calm, rational approach. He also warns investors to be cautious of advisors who promise unrealistic returns or encourage speculative behavior. Many advisors may be tempted to recommend more aggressive strategies in an effort to generate short-term gains, but these strategies often come with significant risks. Graham stresses that the role of the advisor is to protect the client's capital and to help them achieve reasonable long-term returns. Graham advises investors to ask pointed questions when selecting an advisor, such as how they are compensated, their investment philosophy, and whether they have a history of recommending risky, speculative investments. It's important for the investor to fully understand the advisor's approach and to ensure that it aligns with their own risk tolerance and financial goals. Finally, Graham makes a strong case for the importance of educating oneself. Even if you rely on an advisor, it's crucial to have a solid understanding of investment principles so you can make informed decisions and properly evaluate the advice you receive. In this way, the investor becomes an informed participant in the process, rather than blindly following the advisor's recommendations. Chapter 11. Security Analysis for the Lay Investor, General Approach. In Chapter 11, Graham introduces the concept of security analysis, a critical component of intelligent investing. Security analysis is the practice of evaluating a company's financial health and determining its intrinsic value before making an investment. While this may sound daunting for the average investor, Graham reassures us that the basic principles of security analysis can be understood and applied by anyone willing to learn. Graham breaks down the process into three main components. 1. Evaluating a company's earnings. The first step in security analysis is to examine a company's earnings over time. The intelligent investor should focus on companies with a consistent history of earnings growth and stability. Companies that have been able to generate steady profits in good times and bad are more likely to continue doing so in the future. 2. Analyzing the company's financial position. The next step is to assess the company's balance sheet, focusing on its assets, liabilities, and debt levels. A company with a strong financial position, meaning low debt and a healthy amount of assets relative to liabilities, is less likely to face financial difficulties during economic downturns. 3. Assessing the company's dividend history. Dividends are an important indicator of a company's financial health and its commitment to returning value to shareholders. Graham suggests that investors look for companies that have a long history of paying regular dividends. This demonstrates that the company is not only profitable, but also willing to share its profits with investors. Graham acknowledges that not all investors will have the time or expertise to conduct in-depth security analysis. For those individuals, he suggests focusing on companies that meet a few basic criteria, such as a low price-to-earnings, PE ratio, a strong balance sheet, and a history of consistent earnings and dividends. He also reiterates that it's important to focus on companies whose stock prices are trading below their intrinsic value, thus providing the all-important margin of safety. By buying stocks when they are undervalued, the intelligent investor can protect themselves from significant losses and increase the potential for long-term gains. Chapter 12. Things to consider about per-share earnings. Chapter 12 delves deeper into the topic of earnings, specifically per-share earnings, and how investors should interpret this critical financial metric. per-share earnings, EPS, is the portion of a company's profit allocated to each outstanding share of common stock and is a widely used measure of a company's profitability. Graham warns, however, that EPS can be a deceptive metric if not carefully examined. He points out that earnings can be manipulated through accounting practices, making it difficult for investors to assess the true financial health of a company. For example, companies may use creative accounting techniques to inflate their earnings in the short term, such as deferring expenses or recognizing revenue prematurely. Graham emphasizes that investors should not rely solely on EPS when evaluating a company. Instead, they should look at a range of financial metrics and consider the company's earnings over a long period, rather than just focusing on 1 or 2 years of data. This long-term perspective helps to smooth out any anomalies and provides a clearer picture of the company's overall performance. In addition, Graham introduces the concept of normalized earnings. This refers to a company's average earnings over a period of several years, adjusted for any unusual or one-time events that may have artificially inflated or deflated its earnings in a particular year. By focusing on normalized earnings, investors can get a more accurate sense of the company's true earning power. Finally, Graham advises investors to be cautious of companies with highly volatile earnings. While such companies may offer the potential for high returns, they also come with a much greater level of risk. The intelligent investor should prioritize companies with stable, consistent earnings growth over those with wild fluctuations. Chapter 13, a comparison of 4 listed companies. In Chapter 13, Graham provides a practical application of the principles of security analysis by comparing 4 real-life companies. He uses these examples to illustrate how the intelligent investor can apply the techniques discussed in the previous chapters to make informed investment decisions. The 4 companies Graham examines differ in size, industry, and financial strength, but they all provide valuable lessons for the investor. Through this comparison, Graham shows how to evaluate a company's earnings, financial position, and dividend history, and how to determine whether the stock is undervalued relative to its intrinsic value. This chapter is a hands-on exercise in applying the value investing framework, and it serves as a reminder that intelligent investing requires a thoughtful and disciplined approach. Graham encourages investors to go beyond the headlines and perform their own analysis, focusing on the fundamental strengths and weaknesses of the companies they are considering. One of the key takeaways from this chapter is the importance of comparing companies within the same industry or sector. By doing so, investors can gain a clearer understanding of which companies are truly undervalued and which may be overpriced. This comparative approach is essential for identifying bargain opportunities and ensuring that the investor is not overpaying for a stock. Another important point Graham makes is that even companies with solid fundamentals may not be good investments if their stock prices are too high. Value investors must always focus on the relationship between price and value, ensuring that they only invest when there is a sufficient margin of safety. Chapter 14, Stock Selection for the Defensive Investor. Chapter 14 is essential for those investors who prefer a conservative, hands-off approach to investing, what Graham refers to as the defensive investor. In this chapter, Graham outlines a series of criteria to help the defensive investor select stocks that offer stability, safety, and reasonable returns. The chapter's core message is that defensive investors should focus on high-quality companies with a history of strong financial performance, and that they should avoid speculative, high-growth stocks. Graham presents several key principles for stock selection. 1. Adequate size of the company. Graham advises that defensive investors should focus on large companies that are well-established and financially stable. These companies are less likely to experience the dramatic earnings fluctuations that smaller, more speculative companies might face. In today's terms, this typically means investing in blue-chip stocks or companies that dominate their industries. 2. Strong financial condition. The defensive investor should prioritize companies with strong balance sheets, those with low levels of debt and ample working capital. This helps ensure that the company can survive economic downturns and continue operating even in challenging times. 3. Earnings stability. A company with a history of stable earnings is less risky and more likely to continue generating profits in the future. Graham suggests that defensive investors look for companies that have shown consistent earnings growth over the past 10 years, avoiding those with erratic or unpredictable earnings. 4th, dividend record. Companies that regularly pay dividends tend to be more financially stable than those that do not. Graham recommends focusing on companies with a long history of uninterrupted dividend payments, as this signals that the company has been consistently profitable and is committed to returning value to its shareholders. 5. Moderate price to earnings, PE ratio. The defensive investor should avoid stocks with excessively high PE ratios, which indicate that the market has high expectations for future earnings growth. High PE ratios often lead to overpriced stocks, increasing the risk of loss if the company fails to meet expectations. Graham suggests looking for stocks with a PE ratio of no more than 25. 6. Moderate price-to-book, PB ratio. Similarly, Graham advises against investing in companies with a high price-to-book ratio. The PB ratio compares a company's stock price to its book value, the value of its assets minus liabilities. A low PB ratio indicates that a stock may be undervalued relative to its assets, making it a safer investment. By following these criteria, defensive investors can build a portfolio of high-quality stocks that offer long-term stability and reasonable returns. Graham emphasizes that the key to successful defensive investing is not to chase high returns, but to avoid significant losses. The defensive investor's portfolio should be resilient enough to withstand economic downturns and market volatility, allowing the investor to remain calm and patient even in turbulent times. Chapter 15. The concept of defensive investing. Chapter 15 returns to one of Benjamin Graham's foundational ideas, the principles of defensive investing. This chapter is a cornerstone of his investment philosophy, aimed at helping investors build a strategy that minimizes risk and maximizes the potential for steady, long-term returns. Graham defines the defensive investor as someone who seeks to preserve their capital while generating moderate returns. Unlike the enterprising investor, who may engage in active stock picking and market timing, the defensive investor prefers a more passive approach. Their goal is to avoid big mistakes and to protect themselves from the pitfalls of emotional investing. One of the key concepts Graham emphasizes is diversification. By spreading investments across a variety of stocks and bonds, the defensive investor reduces their exposure to any one company or sector. Even if a few of the investments underperform, the overall portfolio is protected by the performance of the other assets. Graham then outlines the key principles of defensive investing. 1. Invest in large, conservatively financed companies. The defensive investor should focus on companies with a strong financial position, meaning low debt levels and a solid balance sheet. These companies are better equipped to survive economic downturns and are less likely to face bankruptcy. 2. Seek a long record of dividend payments. Consistent dividends are a sign of a company's financial health and stability. A long history of regular dividend payments suggests that the company is generating steady cash flow and is committed to returning value to its shareholders. 3. Avoid high-growth stocks. While growth stocks can provide substantial returns in the short term, they often come with significant risks. The defensive investor should avoid chasing high-growth companies and instead focus on steady, well-established businesses with a proven track record. 4. Diversify the portfolio. A well-diversified portfolio protects the investor from the risks associated with any single stock or industry. By holding a mix of stocks, bonds, and other assets, the defensive investor can ensure that their portfolio is resilient in the face of market volatility. 5. Maintain a balanced approach to stocks and bonds. Graham recommends that the defensive investor keep a balance between stocks and bonds, adjusting the ratio based on the market conditions. A typical range might be 50% in stocks and 50% in bonds, but the exact split can vary depending on the investor's risk tolerance and the state of the market. By following these principles, the defensive investor can avoid the speculative behavior that often leads to significant losses. Graham emphasizes that the key to success is patience and discipline. Defensive investing is not about chasing the highest returns. It's about building a portfolio that can withstand the test of time and protect the investor's capital through both bull and bear markets. The chapter also stresses that defensive investing doesn't mean accepting mediocre results. By following a disciplined approach, the defensive investor can achieve solid returns over the long term without taking on unnecessary risks. Chapter 16. Convertible Issues and Warrants. Chapter 16 explores two specialized financial instruments that may be of interest to both defensive and enterprising investors: convertible issues and warrants. While these instruments can offer unique opportunities, Graham cautions investors to fully understand the risks involved before considering them as part of their portfolios. 1. Convertible issues. Convertible securities, such as convertible bonds or preferred stock, are hybrid instruments that combine the characteristics of both stocks and bonds. They offer the investor the option to convert the bond or preferred stock into a specified number of common shares. This gives the investor the potential to participate in the upside of the company's stock price while still earning interest or dividends like a traditional bondholder. Graham notes that convertibles can offer an attractive combination of income and potential capital appreciation. However, they often trade at a premium to their intrinsic value due to the conversion option. Investors should be cautious of overpaying for this potential upside. He also advises that convertibles are best suited for enterprising investors who are willing to engage in more complex analysis. For the defensive investor, the potential risks, including the possibility of the stock price falling significantly below the conversion price, may outweigh the benefits. 2. Warrants. Warrants are another type of financial instrument that gives the holder the right, but not the obligation, to purchase a company's stock at a specified price within a certain time frame. Unlike options, which typically have a shorter time frame, warrants can often extend for several years. Graham warns that warrants are highly speculative and should be approached with caution. While they offer the possibility of significant returns, if the stock price rises above the strike price, they can become worthless if the stock fails to reach that level within the warrant's time frame. For this reason, Graham argues that warrants are generally too speculative for defensive investors. They may be suitable for enterprising investors who are willing to take on the additional risk, but even then, Graham advises against allocating a large portion of the portfolio to warrants. The key takeaway from this chapter is that while convertible issues and warrants offer unique opportunities, they come with added complexity and risk. Graham advises investors to carefully weigh these risks against the potential rewards and to ensure that they fully understand the instruments before including them in their investment strategy. Chapter 17. 4 extremely instructive case histories. Chapter 17 provides 4 detailed case histories of companies whose stocks were at various points either undervalued or overvalued. By examining these real-world examples, Graham demonstrates how the principles of value investing can be applied in practice and highlights the dangers of speculative behavior. 1. Northern Pipeline Company. In the early 20th century, the Northern Pipeline Company's stock price was trading at a significant discount to its intrinsic value, largely due to a lack of investor interest. Graham and his colleagues recognized that the company's assets were worth far more than the market price and began acquiring shares. This case illustrates the importance of patience and the value of thorough analysis. Over time, the company's stock price rose to reflect its true worth, and investors who had bought in at the undervalued price were rewarded. 2. Penn Central Railroad. Penn Central was a classic example of a company whose stock price was propped up by investor enthusiasm, despite serious underlying financial problems. The company eventually declared bankruptcy, and its stock became worthless. Graham uses this case to warn against the dangers of speculative investing and the importance of analyzing a company's financial health before making an investment. 3. Ling Temco Vought, Ltd. Ltd was a conglomerate that expanded rapidly through aggressive mergers and acquisitions. While its stock price soared during the conglomerate boom of the 1960s, the company's financial position became increasingly precarious as it took on massive debt. LTV's eventual financial troubles serve as a reminder of the dangers of over-leveraging and the importance of focusing on a company's balance sheet. 4. Anheuser-Busch. This case demonstrates the opposite side of the equation, how a company with strong fundamentals can be a great long-term investment, even if its stock price seems high at first glance. Anheuser-Busch was a dominant player in the beer industry, with a strong brand and consistent earnings growth. Over time, its stock delivered solid returns for investors who were willing to focus on the company's underlying strength rather than its short-term stock price movements. Through these examples, Graham illustrates the importance of fundamental analysis and the dangers of speculative behavior. Each case reinforces the core principles of value investing: buying stocks when they are undervalued, avoiding speculative booms, and focusing on a company's long-term fundamentals. Chapter 18. A comparison of 8 pairs of companies. Chapter 18 offers another practical lesson in security analysis by comparing 8 pairs of companies from different industries. Each pair includes one company that adheres to Graham's principles of value investing and another that exemplifies more speculative or growth-focused behavior. This chapter emphasizes the importance of sound analysis, highlighting how different companies within the same industry can offer vastly different opportunities for the intelligent investor. Graham organizes his comparison around several key factors. 1. Earnings stability. He compares companies with consistent, steady earnings growth to those with erratic or overly optimistic earnings projections. The companies with stable earnings typically have lower risk, as they can weather economic downturns and continue to deliver value to their shareholders. 2. Dividends. The companies Graham favors are those with a long history of paying dividends. These companies signal financial health and a commitment to rewarding shareholders, whereas companies that pay little or no dividends may be reinvesting heavily in speculative growth opportunities, adding significant risk. 3. Financial strength. Graham examines the company's balance sheets, focusing on those with low debt levels and strong financial positions. Companies that are overly leveraged may face financial difficulties in periods of economic stress, making them riskier investments. 4th, valuation. The comparisons often come down to valuation. Graham points out that many growth-oriented companies may be overvalued due to market enthusiasm, while more conservatively managed companies are often underappreciated. He stresses that the intelligent investor should always be focused on the relationship between a company's intrinsic value and its stock price. Through these comparisons, Graham once again emphasizes the importance of selecting investments based on solid fundamentals rather than speculative hope. His message is clear. Investors must be wary of paying too high a price for growth and should focus on companies that are undervalued by the market, with strong financials and a long history of stable earnings and dividends. This chapter reinforces the idea that two companies in the same industry may offer vastly different prospects. By applying the principles of value investing, the intelligent investor can identify the stronger, more reliable company, even if the market temporarily favors the other. Chapter 19. Shareholders and Management's Dividend Policy. Chapter 19 focuses on the relationship between shareholders and management, with particular attention to dividend policy. Graham argues that the issue of dividends is central to this relationship because it reflects how well management is aligned with the interests of shareholders. Graham starts by discussing the purpose of dividends and why they matter to shareholders. Dividends represent a tangible return on investment, a way for companies to share their profits with the owners of the business. For Graham, the payment of regular dividends is an essential indicator of a company's financial health and management's willingness to reward its shareholders. He then contrasts this view with companies that retain earnings instead of paying them out as dividends. Some companies may argue that reinvesting profits back into the business will lead to greater growth and ultimately higher stock prices. However, Graham warns that this can be a risky strategy, especially if management makes poor decisions about how to allocate capital. Shareholders should be skeptical of companies that retain all their earnings but fail to deliver meaningful growth or returns. Graham also discusses the rights and responsibilities of shareholders in relation to management. Shareholders, as owners of the company, have the right to demand transparency and accountability from management. They should be informed about how the company's profits are being used and have a say in decisions about dividend payments. At the same time, Graham cautions shareholders not to be too demanding in terms of dividend payouts, especially if the company is facing legitimate reasons for retaining some of its earnings. For example, if a company needs to reinvest in its operations to remain competitive, it may make sense to retain a portion of its earnings rather than paying out all profits as dividends. Ultimately, Graham encourages a balanced approach. Investors should seek companies that have a reasonable dividend policy, one that provides shareholders with regular, tangible returns, while also allowing the company to reinvest in its future growth. By focusing on companies with a strong track record of dividends, investors can avoid the risks associated with speculative, growth-at-all-costs strategies. Chapter 20. Margin of safety as the central concept of investment. In this final chapter, Graham returns to one of the most critical ideas in his investment philosophy: the concept of the margin of safety. This is the principle that every investment should be made with a significant cushion against potential losses, ensuring that the investor is protected even if things do not go as expected. The margin of safety is the difference between a company's intrinsic value and its market price. If a company is worth $100 per share but is trading at $70, the investor has a margin of safety of $30. This cushion allows the investor to avoid substantial losses in the event of market volatility, poor earnings, or other unforeseen events. Graham emphasizes that the margin of safety is the most important tool an investor can use to manage risk. By only buying stocks that are trading significantly below their intrinsic value, the investor reduces the likelihood of permanent losses. Even if the company experiences temporary difficulties, the margin of safety provides a buffer that allows the investor to hold on through tough times without suffering large losses. This concept applies not only to stocks, but also to bonds and other investments. Graham warns that too many investors focus solely on potential gains without considering the possibility of losses. By always keeping the margin of safety in mind, the intelligent investor can avoid the traps of speculation and emotional decision-making. Graham also stresses the importance of patience and discipline. Building a portfolio that provides a margin of safety requires waiting for the right opportunities. The intelligent investor must resist the temptation to chase market trends or buy into speculative booms. Instead, they should focus on finding solid companies whose stock is temporarily undervalued, providing the margin of safety that is essential for long-term success. In concluding, Graham reminds us that no one can predict the future with certainty. The margin of safety is a way of acknowledging this uncertainty and protecting oneself from its risks. For Graham, this is the central concept of investment, the key to navigating the markets with confidence and security. By always demanding a margin of safety, the intelligent investor can achieve consistent, long-term returns while minimizing the risk of significant losses. Conclusion: the timeless lessons of the intelligent investor. As we conclude our exploration of the intelligent investor, we reflect on the timeless principles that Benjamin Graham has imparted throughout this work. His emphasis on disciplined, rational investing, the avoidance of speculation, and the critical importance of a margin of safety has guided generations of investors toward financial success. The wisdom of Graham's philosophy lies in its simplicity and practicality. While markets may change, human behavior often does not. Investors will continue to be swayed by greed, fear, and short-term thinking. But the intelligent investor, armed with the principles outlined in this book, can navigate the markets with confidence and achieve lasting success. Thank you for joining us on this journey through The Intelligent Investor. We hope this exploration has provided you with valuable insights and tools to help you become a more thoughtful, disciplined investor. Remember, true success in investing comes not from chasing quick returns, but from following a methodical, long-term approach grounded in sound principles.